Hey, what's up, guys? Sam here, kicking off the big picture session. For those of you guys that have been following along with these sessions, basically every time I've had a big picture session in this room with you guys, I've brought you just one thing, right? And I got a lot more serious about it in December. So this is going to be kind of there might be a third part to this, but this will definitely at least be kind of a comprehensive second part. So the first part you guys already know about, which we talked about already, which was the yield curve signal. I'm going to cover that again, and then we're going to cover a lot of other things here that I think are important. So let's dive in. So let's start here with the primary signal. So let's start kind of at the beginning and the most important signal, certainly. So this is the yield curve signal. And for those of you that have already caught this stuff in the past, just bear with me for a little bit. I want to make sure that everybody, whether this is the first time they're hearing this or you've heard this over the last. I think I do one of these every month, so this will be the third one since December. But I want to draw your attention to just one thing, and that is the yellow line here on this chart. So there's a yellow line here, and it goes back to here, and here, and here, and here, and very much here. Okay. So what is the yellow line? The yellow line is 0, right? It's just 0 on this chart. Let's understand this chart for what it really is, right? One thing that I never really care too much to do is to approach this stuff as if I were a teacher, because I'm not, right? I'm a trader. I never really even was a particularly good student, although I got good grades. So I'm going to present this to you more so from an abstract perspective with a deep understanding of what's actually going on. But you don't really need to understand like the intricacies of the yield curve as long as you understand the implications of the signal. And I'll try to keep it as straightforward as possible. So let's just start real quick with what is the yield curve. So I'm going to do this as fast as I can because I think a lot of us, especially those of you that have been following along already know this stuff, but for the sake of completion. So what is the yield curve? Okay, so yield curve measures, oh geez, that's my friend kicking me off, measures the spread / difference between two maturities. Okay, in this case, it's the 10-year and 3-month, right? So what we're looking at, what are we really looking at here? What are we really looking at here? Looking at the difference between the cost to borrow money for 10 years minus 3 months. Now, ask yourself this. You guys are all familiar with interest rates in your own way, right? If you wanted to borrow money and you wanted to borrow money for 10 years, would you expect to pay more or less than you would for 3 months? Right. So let's say that you go up to a banker friend or whoever, you want to borrow money for 10 years, they're going to give you a quote for some price, right? Let's just say it's 5%, just random number, 5% for 10 years. Okay, well, if you wanted to then instead say borrow money for 3 months, would you think that it would be more or less than for 10 years? And like you guys are posting in the chat, it would probably be more. In a normal situation, you would expect to pay a higher interest rate for 10 years. Right? That makes sense. Anything can happen. There's so much more risk. And whoever's loaning you the money is going to not have their money for 10 years. So they're going to want to be compensated for that. However, with yield curve inversion, this is backwards. The market ends up demanding more interest / money for 3 months than 10 years. Now, we can get into why, but it doesn't really matter. Just understand this. I'll even put this in the notes. We can get into the why, but we don't really care. You're not here to take a test. You're here to use this stuff to save your butt and to hopefully make a little bit of money. So we can get into the why, but it doesn't really matter for what we do as traders. What does matter is to understand this is not normal, right? And I think we can all just immediately click with that, right? We can all understand, like, that's a little bit weird. Why would you charge somebody 5% for 10 years and let's say 8% for 3 months? Isn't that weird? That's just weird, right? If nothing else. Okay. So what does this signify? It signifies risk and instability. These are rare moments in time. Okay. So that is our deep dive, if you will, into the yield curve, right? Now we are all yield curve experts insofar as we need to be. So what does it end up looking like on a chart? Well, the yellow line shows the inversion, right? So this is when the graph here, the chart gets below the yellow line, that's just the weird moment that we were just discussing. That's weird, that's weird, that's weird, that's weird. And this one, I would say, is super weird, right? Because of the size. Okay, so now we know when to isolate it. So what's happened here? Well, in 89 and 90, if you go back and you look at the market, there was a little bit of a market pullback. Let's go to a little bit more recent. I think the more recent examples are all examples we will all know, even if you haven't been trading that long. So what happened in 2000 and 2001? Anyone recall? If you market historians recall, .com, right? 9/11, right? Okay, well, that was one instance. What happened in 2007, 2008? Well, they made movies about that, right? It was the great financial crisis. Okay, so that's instance number 2. What happened in 2019, 2020? That was a little thing called a global pandemic. And then what's happening now, right? And remember when I showed you this in December and the signal had triggered, and I'm going to cover the trigger here, I told you I don't know what's going to cause this, right? But I also try to stress that it doesn't really matter, right? It's not usually something that's extremely obvious, at least in the moment. It is usually obvious in hindsight. And so let's go into the trigger, right? So the problem isn't the fact that it's negative like this, right? Like a lot of folks will misinterpret this and say that, oh, it's been negative since, here, right? Why did we not have any issues here or here or here or here, right? Because it's been negative for years. That's not the issue. The issue happens when you rip out. So the trigger is when you go below zero and then back above, below zero, back above, below zero, back above, below zero, and then finally in December, right there, back above. Okay. So that's the trigger. So what then triggers? Well, here was .com. Market pulled in, I believe, 80 something percent, at least the NASDAQ. Here was a great financial crisis. I think that one was good for about 50, 60%. This one was COVID. This one was really fast. I think this one was only good for about 30, 35%. And we don't really know what's going on here quite just yet. Okay. Last point that I want to make. Once the signal triggers and you actually go from below zero, back above zero, below zero, back above, below, back above, and then below, back above, notice that there's kind of a common area where this thing typically goes up to, right? It typically goes up into this zone here, right? It did it there, it did it there, it did it there, right? Now, what do you notice here about the most recent example? We're going to come back to this, but notice how during COVID, it didn't even come close to hitting that upper line. Okay, that's unusual, right? If we're just looking at it from a historical perspective, we can very quickly understand that if we draw a straight line across, it typically tops out historically there. This time it did not. And not only did it not, it didn't even come close. Okay, we'll come back to that. So basically, what does this mean? Well, these moments in time, these have led to credit events. So credit events basically means, so let's move on to the next part, credit events. So these are moments in time where the entire system is over levered and there are mass liquidations / bankruptcies, which resets everything. Okay, so that's kind of what the implication here is, that that's what's setting up next. So let's see, we covered that. Okay, so let me kind of finish the yield curve, and then I'm going to show you other charts. So as we go along, I do want you to be aware that I want to put this out there very, very strongly. As I show you this stuff, I want you to kind of take it all in, maybe even make notes or just go back and watch the recording if you need to. But I want you to approach this not with the perspective of Sam knows anything. I want you to approach this with the exact opposite perspective. Approach it with the perspective that Sam is your local idiot and he knows nothing, but he has presented something to you that is worth at least investigating. And then I want you to do the work on your own, right? I want you to pull up all the charts that I'm going to show you here in just a minute. I want you to pull these up on your end when you have some time. And I want you to actively work to disprove them, right? Don't go into it trying to prove what I'm showing you. Go into it trying to disprove what I'm showing you. And then and only then will it actually resonate with you. So let's finish the conversation here with the yield curve. And then I'm going to show you the other charts that tie all of this together. So one point that I want to make here, because the reason that I kind of put myself out there a little bit, right? This doesn't make me very popular. Nobody likes this, right? Everybody thinks that I'm a downer. You know, the self-appointed nickname that I've given myself is Sammy Showers, right? After today, I'm gonna call myself Sammy Sunshine, because this will be the last time that I have to tell the scary story, but I'm gonna tell it in the most complete way I can. So nobody likes me doing this, right? Nobody even says thank you. Well, actually, like 2 people have told me thank you, right? Most people just don't like this. They because you're just not going to like what I'm going to tell you. But again, I don't tell you this because I have anything to gain. I think that's extremely important, right? I'm not selling. I have no class to sell you. I have no indicator to sell you. I have nothing to sell you, right? I see a signal. I recognize it as the biggest signal in the last 40 years. And I think it's my job to tell you about it so that you can take precaution. And that's really what it is. So if you can, just to slightly appreciate the fact that this makes me no friends when I show you this. So I get no joy from showing you this because it doesn't make me particularly popular. So let's finish up the conversation here on the yield curve so that we're all on the same page. Okay, so we recognize the trigger is below zero, back above, below zero, back above, below zero, back above. These have all been historical moments in time. What do you notice about this one that's radically different than the ones before? I would say there's 2 things. One is the depth of the inversion, meaning how low it went, right? If you kind of draw a straight line across the previous inversions, you see they kind of all have a floor roughly right about there, right? So that's the first thing I noticed. The second thing I noticed is the length. The duration of the inversion is massive, right? It is absolutely freaking massive here. Because if you look at the duration here, that's, these are monthly charts. So, these are pretty long, but look how long this has been compared to the previous ones. Okay. So that's 1 point. Second point is, before COVID, we had this signal, which I also warned you about before COVID started. But notice how, again, it didn't actually come up to the top of the range like it has historically every time. So here's my contention to you. My contention to you is that whatever is next, which I will briefly touch on at the end of this session, whatever is next should have happened here, right? It should have happened there. This should have gone all the way up here. and there should have been a mass liquidation, mass credit event that happened during COVID, but it didn't. Right. The reason that it was prevented is because world governments, not just the U.S., but literally every country in the world, printed more money than has ever existed. Right. So that, in effect, kind of kicked the can down the road. So what did that lead to? Well, that led to the deepest and longest inversion, at least in the last 40 years. So here's my contention to you. Again, I always want to show you this stuff in a more abstract way, not in a technical way. So think of it this way. You pull a rubber band back and then you snap it forward, right? You pull the rubber band back, snap it forward, pull the rubber band back, snap it forward. Well, wouldn't it make sense that the further down that you pull the rubber band, the harder up it will snap? I would say that logically does make some level of sense, right? So again, presenting this stuff in a really abstract way, but hopefully it clicks, right? I view this as the deepest, the most pulled back the rubber band has been in 40 years. And therefore I would assume that the snap back from that rubber band will be the biggest that we've seen. Okay, so that is the long and short on the yield curve. That's just one piece, but it's the most important piece. It is the most important piece because keep this in mind, the stock market is an emotional animal, right? The stock market is it's just frankly it's in some ways it's glorified gambling, right? It's a lot of retail, it's a lot of emotion. It moves on vibes more so than a lot of other things. Whereas the bond market is a little bit more of a mature market, right? Not only is it a more mature market where it actually moves on some level of fundamentals, less so on vibes and feelings, but it's also significantly larger by multiples than the stock market. So the signal that I'm showing you here is being generated by the biggest and what would mostly be considered the most intelligent and most savvy investors in the world. This is part one of the conversation. Let's move on. So let's move on to charts, because if I'm telling you that there's going to be some bad things that will happen, then I surely should be able to show it to you on a chart. And as you take anything that I share with you today and run it by your own work, make sure that you can reference charts, right? Because I remember before all of this started to trigger, there were folks that would push back on this idea and say that, well, we've been inverted for 2-3 years, therefore this doesn't matter, or something along those lines. But that shows, one, it shows a lack of understanding of how it works, and two, it shows no charts. So let me show you charts. So this is going to be just a SPY. This is SPY monthly, quarterly, monthly, and weekly. One thing that I want you to note here is, and we're going to keep this really, really simple, hopefully. So let me actually clean this up just even a little bit more. So I want you to notice just 3 signals that I'm looking at, and we'll focus, let's focus here on the monthly for now, and then we'll bookend it. So on the monthly chart, there's 3 signals I'm looking at. The number one signal is, or the first signal, it's actually the least important one, but it's the first signal, and that's just going to be price pivots, and that comes in the form of arrows, right? Very simple, right? Down arrow, up arrow. You got a little bit of a wiggle here, but the last signal that was active was that signal there, right? So the last signal that was active was that arrow with that arrow and with all of these arrows underneath it there, right? You can see that moment in time right there. And that launches you basically from, let's call it 440-ish, all the way up to about the highs, 613. What we're looking for is for a change of this common signal. We want all 3 things to hit. And I want you to note that last month, you triggered that signal, and that signal all at once, right? So what does this mean? Well, to me, at the very minimum, that means that we have to, we already did this as of yesterday, basically, but we have to come down and retest 480. I think in many scenarios, based on the totality of the signal that I'm seeing, this actually will need to come back down to about right there, which is 350, right? If you guys recall, when I show you patterns in the room, remember the one thing that you're not allowed to do, right? You had a breakout from 480. You're not allowed to break out and then come back and get below 480, right? You're allowed to come back to test 480, right? It's basically a breakout retest. And if we were to retest and then go higher from here, then all is well. But one thing that you're not allowed to do, and this is just a hyper big example of it, is to break out from a level, in this case 480, break out, and then come back and get below the level. Because what happens then? If you do that, that typically will put you all the way back down to the bottom part of the range, which would be about 350, right? So that would be another 1,500 S&P points. S&P's trading 5,000, so about 3,500 S&P would be kind of the initial target. Okay, so I wanted to show you that. Another thing here that I need to show you is notice how we're making pulses higher, right? You see these 3 pulses higher. This is a quarterly chart now, right? Market has gone up 3 pulses. Notice how in the trend oscillator here, you have 3 pulses lower. A little hard to see there, but pulse 1, pulse 2, pulse 3, each one is lower, price went up. So basically what that tells me is that we made the most recent high. It always happens in threes. We made the most recent high on the lowest momentum basically since like 2017 or something, right? So basically what that means, what that translates to, is this is an unstable high, and it increases the probability significantly that the pullback to 480 will not hold. If that is the case and 480 does not hold, that increases the probability that we have to fill this entire gap here down to 350, right? So all eyes here should be on 480, basically 4,800 on SPX. That's going to be your do or die kind of level there. So that ties in the monthly chart with SPY and the yield curve signal, right? If it was just the yield curve or if it was just SPY, it wouldn't be as meaningful, but it's more meaningful when it's all of them. And then lastly, I'm going to show you VIX. Now with VIX, it's a little weird to track VIX, right? It's a little weird to chart it, but I just want to draw your attention to just one very simple thing, because there's going to be a lot going on here on this chart. And keep in mind, the VIX is kind of it's a mean reversion thing, right? So it's not going to trend. You can't really chart it the same way you would other things. But I want to draw your attention to one thing. On the quarterly chart, you have 2 bars against the grain, right? So you can see how the squeeze histogram, this is bullish for markets because the squeeze is going negative. But once you start hitting the inflection point, especially when it happens with this little guy right there and that guy right there. So remember what we're looking for. There's an arrow here. That's a pivot. That happened. And then this happened most recently. You see the alignment. What this tells me is it tells me that this is very much not over and that you're going to get basically a significantly long, protracted move lower. If we look at it on the monthly chart, it comes across a little bit more cleanly, right? Here you can see the alignment of the signal pretty cleanly. And again, if the squeeze histogram was look like that and then had a hook lower, then I would say, okay, this is probably close to over. But it basically looks like that. But you can see that the squeeze histogram is actually still negative and hasn't even crossed the 0 boundary, meaning that this is not anywhere close to over. It'll be hard to keep the VIX at 48 to 50. It's just that's a very high number, but it does mean that the VIX will probably be elevated for some bit of time based on the signal. So that's the VIX. Let me keep going here because then we have to tie it back to credit. Now, HYG, for those of you that are unaware, it's basically junk bonds. So think of HYG as so think of it like this. There's two people. You have John Carter and you have a bum, right? Let's say it's your Uncle Bob, who's like, you know, I don't want to throw Uncle Bob under the bus. Let me just call him a bum, right? So you have John Carter, who's got, a very high credit score, makes a lot of money, all this other stuff. And then you have a bum on the other end, right? So that's HYG would be a chart of the bum, right? So what does this mean? If this chart's going up, if HYG is going higher, it basically means that the bum and John Carter are getting very similar cost to borrow. So the bum walks into the bank, wants to borrow money, and the bank charges him 5%. John walks into the bank, significantly better credit risk, wants to borrow money, and the bank charges him maybe 4.5%, right? That's a very tight spread. If the bum walked into the bank and wanted to borrow money and the bank charged him 50% and then charged John 5%, right? That would be a wide spread. Long story short, what this means is if this chart's going up, the difference between crappy companies and good companies to borrow is basically very, very similar. If this chart starts to fall, it means that crappy companies have to pay a lot more than good companies to borrow money, right? So this is a very important chart. Just understand, and really you don't even need to understand all of that. Just understand if this chart goes lower, it's not a good sign at all. This is one of the most important charts, and really just understand down is bad, up is good. So again, what are we looking for? We're going to keep things simple. We're just looking for signal alignment. What do we see here on the monthly chart? These are fresh signals, right? Also, notice how the squeeze histogram is starting to hook this way, right? So this again is just the beginning. So what does this tell me? Well, this tells me that this is going to go back to probably the COVID lows. So all of these pieces are just pieces of the puzzle, right? Like I'm not saying let's go short HYG. I'm not saying let's go do X, Y, or Z. I'm putting all of these pieces together and saying, okay, we start with the top down, and maybe it'll help if I actually put it on some notes. So let's look at it from top down. Top down, most important to least, or most important signals. Let's just put it that way. Number one, yield curve. Number two, frankly, I would actually put HYG here. Credit spreads. Three, stock indexes. Four, volatility. Okay. And so notice how all of these, as we go through this, every one of these signals is telling us the same exact thing. Let's go one step further, just because we can. So if you wanted to chart, let's say Asia, right? If you wanted to chart risk in Asia, do you have a good way to do it? You don't have to answer in the chat, but just in your own head, what would be one symbol that you would look at to say risk on or risk off in Asia? Right? Let's take it away from the US markets and go over there. Yen is a way to do it. Yen is actually, I'm going to show you the yen, but well, let's do this. Let's try this one first, because this is actually the purest way to do it. And then I'll actually show you the yen specifically. So in my opinion, the real answer is actually the Aussie dollar, right? Because the yen is more of a risk off currency, right? If people get scared, they go buy the yen. So yen going up is actually bearish, but if people are bullish, they go buy the Aussie dollar, right? So I don't want to lose anyone here. Again, we're just kind of building up the list here, and all we need to know is up and down, right, for these different charts. And so if you really wanted to get into the nitty gritty of it, you could look. I would actually suggest you look here. Don't look at yen dollar. Don't look at Aussie dollar, US dollar. Look at the Aussie dollar versus the yen. And if this chart is going lower and this chart's giving you sell signals, then that's also not a very good sign, right? So again, what are we looking for? Just arrows. We have one there. We have one there, and we have one there. Notice how this one came perfectly. Now we also have a monthly squeeze breaking short, by the way. And we have quarterly sell signals as well, right? Let's keep it simple though, because this one's a little bit more advanced, if you will. So let's just look at it with 6A. If you are more advanced, I would say definitely use Aussie yen for your long-term work, but and understand Aussie yen going down is going to be bad for markets. But let's keep it simple. Let's go with 6A here. Alrighty. So here's kind of the fast way that I would tell almost anyone to follow what's happening. Now, if I were to restructure this, probably I would actually have to restructure it this way: currencies, because currencies are very, very important, very big markets. Okay, so we're going to look at two things. Is the 6A, because we understand 6A down is bad. We're going to see if the signals are down. And if they are down, are they early relatively, or are they not early, meaning that they've already been down and now they're starting to turn? Then we're going to look at 6J, which is the yen. And we're going to understand that unlike the Aussie, the 6A, which down is bad, on the 6J, the yen, up is bad. So this is yen. This one's Aussie dollar. All right. So what do we see here on Mr. 6A? Well, this looks disgusting to me, right? Like this is really where it should start getting a little bit eye-popping for you guys, hopefully. You see this long support shelf here? That has been in place since basically 2022, right? What do we have here? We have a really, really gross looking chart. So, and again, the key thing here is not to say, oh, it looks bad, because I think that's obvious, especially now that you're breaking this clear floor where you can see it for yourself. But the fact that the squeeze is just one dot into firing, and this is going to take months, right? Keep in mind, squeezes go 8 to 10 bars. And so if it's a quarterly squeeze, that's 8 to 10 quarters. That's 2 years. It's going to take forever. Okay, so 6A has not disproved what we've looked at, right? We're just trying to find one thing, just one thing that disproves our theory, one bright spot. Now we're going to look at 6J, and also keep in mind the 6J up is bad, not down. The only reason anyone's going to buy the yen is because they're scared. So this one's still relatively early. But note how, like the 6J or the 6A that we just looked at, that squeeze had just, you had this like floor and it just broke, and you had the squeeze just starting to fire. That's early. That's fresh. Notice how here, this is bad. This is a bad looking chart, right? We can all agree on that. But notice how it's on the come up, right? It's on the hook. I call these smiles, right? Like these are smiles. So kind of how, and so this chart's starting to improve. And then to prove my point today, this chart's up 1%. Last point I'll make here, and this is a little bit in the weeds, but hopefully you'll see it pretty clearly. Note how the price here is going down and the indicator's gone way up, right? So this is a precursor to a big move. Basically, this is like a coiled spring under the market. So we looked here at 6A, and that understanding down is bad, and that was down and early. We looked at 6J, understanding up is bad, and we understand that that's not working. We looked at the stock indexes. Those are giving early signals. We looked at volatility. That's giving early signals. We look at HYG. That's giving early signals. And of course, the yield curve just triggered in December. So I think that ties that together. So let me just go ahead and cross all of this off, because I do have a big list here of things that I needed to cover with you. So what does it all mean, folks? Well, let's go ahead and finish up here. So most people believed inflation was the problem. However, literally everything we have looked at implies a upcoming credit event. And credit events are by their nature deflationary. Right? That's important. Right? It's hard to have inflation when folks are, the entire system's getting sucked into a black hole essentially. So deflation is the bigger risk, in my opinion, than inflation by far. Okay, so that ties that. All right, so prepare any questions if you have any. We're getting to the end of this. So here's kind of the one thing that I haven't mentioned that that I debated whether I should even say this. And you know what? Just for the sake of completion, I'm going to say it, and then I'll just preface it by saying that if anything starts to look like something will change, I will change my mind and we'll call an emergency meeting. But for now, I'll just go ahead and say the unnecessary thing that I think that I actually believe. Whatever happens next, this is the last crash in this system. From this, a new system will be created. That's more opinion than anything else, but I do want to put that out there. And let me just go ahead and finish tying all this together. This is the 5% opinion part, so bear with me on this. You don't have to buy into any of this part, but I'll just put it out there for you. In my opinion, this is not tariffs. This is the reset of a very, very unhealthy system that started or was accelerated in 2008 when the government absorbed all of Wall Street's bad bets. Since then, we have lived in a system that demands greater and greater liquidity and is not based on productivity, but rather centrally managed fiscal and monetary liquidity. All signals to me point to the end of that system and the beginning of a new system. Here's the bright spot. This will be good. It's necessary. If your family member had a severe opiate addiction, it would be difficult to see them go through withdrawals. However, you would understand that the end result would be a healthier person than what it started with. In the near term, this means a lot more pain to come, but with long-term positive benefits. All right, I think that might be it. Last point that I'll make here is previously, this is important. How have the central powers saved the system? Lower rates, print money. That's it. My contention is twofold. One, lower rates will not matter when demand destruction happens. right? Doesn't matter what the price of money is if all this stuff starts to happen. 2, can't print money if you're fighting the perception of inflation. So there's no good move to get out of the mess. All right, so I think that's everything. So I do want to kind of highlight the Sammy Sunshine part because that was a lot of heavy stuff that I just hit you with. There's a conversation here around the dollar and the hegemony around the dollar. Um, Keep in mind this is, and I think that's obvious now, this is the US versus China. This is China trying to upend the US system, and what we're doing now with tariffs, and this is again just the beginning. We really haven't seen anything yet. Is our way of fighting China and keeping our dominance at the top. Right. One thing that you'll note, and that if you care to really get nerdy with this stuff, which you don't have to, but if you care to, you'll note that China has a lot more of the world's trade is going through it in terms of the yuan. And of course, we don't like that, right? We want people to keep using the dollar because it artificially creates demand for the dollar, and it's as strong as an army when you have the world reserve currency. So China, what they're doing is they're trying to change that system because it no longer really benefits them, and they want to be the top dog, right? They want to be the world reserve currency, or at least be a bigger part of it. And we as a country cannot really tolerate that. And so what you're seeing now is basically a war. We're calling it a tariff war. We're calling it a trade war, and I suppose that's accurate. But it is a war, and these two powers will be butting heads, and it's unlikely to end with a tweet, and it's unlikely to end without a lot of pain inflicted by both countries, and then one country will cry uncle. So that's the full song and dance, folks. Again, I'll just close out with Sammy Sunshine here, because after today, Sammy Showers is dead and Sammy Sunshine lives. But I do want to just put a positive spin on it, right? One, you're now prepared, right? If nothing else, you can think I'm full of shit, and that's perfectly fair. But go out there and prove it to yourself. I've given you everything you can possibly need here. You can go through one by one and kind of prove me wrong. And if by the end of it, you're like, man, I really couldn't prove any of this wrong, then, that gives you something to do. But the main thing is just being prepared, right? Don't panic. There's nothing to panic about, right? Just be prepared. And then, I'll again say this, that this is a good thing. It was something that was going to happen at some point. It's better that it happens sooner than later. It's certainly better that it happens really quickly than over a long period of time. I think that if they're able to accomplish this within 1 year, that will be fantastic. I do want to stress this as well. This will be a generational buying opportunity, close to the conclusion. Because it has been every single time that we've seen this, right? Literally, these have led to truly generational opportunities. So I do want to kind of put that as well, as a bookend to this conversation that we've had. So if anyone watching has questions, I'm all ears and happy to help you. So I'm going to go through the chat here. Don't be shy. We don't have that much more time left. What was the symbol of the 10-year chart that I did on the Trading View? So let me grab that for you. So if you want to look at this on Trading View, you actually can look at it on TOS as well. I forget what it is on TOS. Let me see if I can figure it out. If any of you have the 10-year 3-month yield curve symbol for TOS, that would be really helpful. 10Y. Let's see if it autofills. It's like 10Y3M. Forget what it is. There's one for TOS as well, but I will. I don't have it on me at the moment. So again, if you have any questions, drop in the chat. If you don't, then thanks for joining the session. Download the notes. Keep your head up. Remember that volatility as traders is opportunity, and being prepared is step number one. So if you have a big picture horizon, this is a generational opportunity. So you've been on this theme for years, but they always print more. Why can't they do it again? They will, is the answer. They will. They always will. They'll print more. Yeah, they're going to lower rates and they're going to print. They only have two moves. They have shake and bake, right? The only two moves they have are print and cut. So they will print more. Um, the problem is they can't print right now because they have to get inflation down by a lot. So then you're correct. They will print more. They always will. If nothing else, remember this too. They only have two moves: print and cut. Print and cut. I mean, it's really effective, but they only have two moves: print and cut. So they will print more. They will cut more. They'll cut before they print, obviously, and they will print more, but they can't do it now. Things have to get much worse before they can justify printing. Right? It's kind of similar to COVID. Do you think that people would have tolerated what they tolerated during COVID if it wasn't presented in that way? Probably not. They probably also would not have tolerated debasing their currency by as much as they have. Right? That was a tremendous debasement of the currency that happened during COVID. We tolerated it because it was under the guise of global pandemic, happens once every 100 years, and so there's always an event that justifies printing, and we haven't gotten there yet. So you're correct. They will print more, but we need to go through a cycle of bad events before they can justify printing, especially now because of inflation. It was easier to print when you don't have inflation. So what is an example of the new system? So again, that's kind of like the 5%. Like maybe we should maybe focus more on the 95% of the stuff that's in the charts. The 5% of the stuff that's kind of like what's the new system? It's probably some amalgamation of like a world currency where it's not the dollar, it's not the yuan. It's kind of a world currency that ties everyone together. That's really the only thing that makes sense. So what am I doing to protect my assets? So I told you guys in December that I moved all of my money to bonds, and then I changed my mind at the end of February, beginning of March, because the bond fund that I have access to is called PIMX, PIMIX, at least through the long-term accounts, and I looked at the prospectus on that, and it has a lot of HYG stuff in it. So basically, it has like bonds from the government, but then it also has a lot of crap that I don't want, that I think will actually get hurt if these events happen. So in December, I moved everything out of stocks into bonds. And then in the end of February, beginning of March, I moved everything out of bonds and put it into what's called a stable fund. And this is for the long-term account. So the stable fund is basically just dollar equivalents. And I'm just going to sit in that for some time. And then hopefully, if I get a entry signal at any point, ideally from much lower prices, I'd like to deploy that cash back into stocks. The problem is I don't see anywhere cleanly to hide is the issue, right? I think that assets across the board will get hit. Including real estate. Usually defensives like utilities or staples would hold up better, and they probably will hold up relatively better, but that just means that I would lose less, and I would rather not lose. So instead of trying to lose less by going into defensives, I'm just going to try to not lose by being in cash for those long-term stuff. Also, be aware of this. We didn't get a chance to cover it in here, but you can just put this on your to-do list. I'm not entirely sure gold will be a great safe haven either, because if we do get a credit event, what happens during credit events? They sell to cover margin calls. And one of the things that's up the most is gold, right? So even though folks may not want to sell their gold, they might be forced to. At least that's what's happened historically. So, and you can just go back and look at a chart of gold back in 2007, 2008, and see that. So I don't see anywhere clean to hide. And therefore, the only place that I would feel comfortable personally on a long-term basis, at least for now, is cash. Do I have any preferred timing windows? Not really. I mean, I think that if the conversations that we're having in here are kind of just already the die has been cast. So it's already, all that stuff's already kind of in motion. Of course, being now in a technical bear market in the indexes, you will get big rallies. You saw one today that was up almost 4%, and then it went red. And now is basically, flattish. So in for this conversation, I'm trying to not have a timing window because it's already started. The best timing that I could have given you was in December when I told you that the timing triggered. From there, it becomes just like you either make a move or you don't, right? Like the way that I kind of describe it is you and I go out to eat, with the intention of dining and dashing, right? We're going to eat, but we're not going to pay. We get 10 chicken wings. I eat 9 of the chicken wings and I leave you with the last chicken wing. Now you have 2 choices. You can either A, eat the last chicken wing, and if they catch you, you have to pay for all 10, or B, you get up and leave and don't eat the last chicken wing and you don't get caught. So you'll always, with this type of perspective, you're always going to leave something on the table, right? You're never going to get at the absolute high, and you're probably never going to get in at the absolute low. But that's why in December I was like, look, you guys might want to just start looking for, consulting people that you believe, that you trust, in terms of what to do. So in terms of timing it, it's already started. It's already started. But we'll keep doing one of these every month or so, and we'll update it as we go. But it's still very early, extremely early. Tim, yeah, we covered gold and silver there. So I think that gold is still a little bit vulnerable. If there was one place that I would feel comfortable, it is actually going to be gold. So I've considered selling my gold. I only have like 20 ounces. I've considered selling it and just going full cash. I haven't been able to do that quite just yet. So the only thing I would say is just don't assume gold will perform well, because at least historically during credit events, it does not. It's just an asset that gets sold to pay for other things. And we'll just we'll call it as it goes, right? If I start to see any reasons to change my perspective, we live in very interesting times. We live in very fluid times. We have a leadership that we have not seen before. And so anything really goes. But hopefully all of the things that we've talked about, especially all through here, these 5 points, these are all aligned right now. And if I start to see maybe one of these start to change, then we'll have another conversation around this stuff. But for now, there's 5 points that I'm looking at. These are the biggest markets in the world, and they're all basically telling us one thing. Mitch, is there any that are less vulnerable? Gold. Silver would be more vulnerable than gold. Copper is more vulnerable than both, and gold will do the best. I probably won't sell my gold, to be honest with you. I've thought about it just because it'd be cool to sell it and then be able to buy it back cheaper, but I'll probably just hold on to it, to be honest with you, with the expectation that it's probably, in the event that all this stuff happens, it'll probably have a decent dip. All right, guys. Well, that's it. That's the session. So that's the full scary story. I thought there would maybe be a part 3 here where I was going to give you my opinion, but I just decided to go ahead and put it all out there today. Again, understand that my opinion is only 5% of this, and it's the least relevant part of all of this, but I just wanted to go ahead and put it out there because I think that all of this is aligned in a specific way. And then, of course, the 95% is the stuff that we've talked about, the list of things that we've covered as well. And then just one bit of homework for you guys is, as you go along and you look at things through your own lens and you consult whoever you consult, let me know what you find, right? Let's stay in touch. Either email me, sam@simplertrading.com, or, talk to me in the room, talk to me on YouTube. Let me know if you're seeing anything change, and, I'll factor it in. And then I'll do the same for you guys, and we'll all navigate this together with a positive mindset. All right, guys, that's my time. Thanks as always. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.